Everybody talks about analysis and how things should be happening on the market, but nobody talks about how things really feel like when you're trading. Today is all about discussing how specific things in market affect our brain and our action when we trade, and what we probably should do instead.
Let's begin with the global stop-loss conspiracy.
Man, there was a time in 2010 I genuinely thought the broker had an issue with me. Now, every time I entered a trade, there was immediate pullback. And with any other entry, I experienced slippage. And the worst thing was that every time when I placed a stop loss, it was hit down to the pip exactly. Now, the thing is, even in 2010, I already had knowledge when it comes to trading. I knew the technical analysis, fundamental analysis. I knew what moves the market, everything there is to know about market function, I already knew back then. And I genuinely thought I discovered the global conspiracy while I was trading my 0.5 lot positions. First, I was blaming the broker for everything that happened. Literally, I was writing letters where I said, okay, this is what you did and now you need to pay me back. And then
The grand awakening execution function.
it kind of forced me to go down the rabbit hole and simply learn a little bit more about execution function. Now, you see, technical and fundamental analysis are a good thing to understand where your entry might be or how you will use your stop loss and take profit and all that jazz. But when it comes to what actually matters, you need to understand the execution mechanisms and how the liquidity works. And as I was going down and learning these things, I discovered few basic things that should everybody know from the beginning, but nobody really does. So as I looked at the execution mechanism, I discovered the uncomfortable truth, and that was, so the market wasn't attacking me and the broker wasn't after me. Although I did have the knowledge about the market, I didn't know deep down how the execution works. And what I really mean by how it works is not how specific execution mechanisms feel themselves. No, this is not what it is. What it really is how our own behavior change depending on the actions and reactions that come from seeing what is happening on the market and how it affects us deeply. And let's start with the one that usually gets the most blames, and that's the slippage. Now, when you trade, on the chart, you will see the last executed price. But when you click or press buy, depending on the device you're using, so your chart will show you a price. You see specific price, and that is pretty much the last executed price. Now you decide to buy, and you press buy on your phone or you click buy on your computer. The difference in between those two moments is milliseconds, yet the price moves in milliseconds. And the difference manifests as slippage. So it's not a villain per se, it's just infamous slippage. And what it really is, it's time plus volatility. Now think about this, when you actually trade, it feels really personal when that happens, when the change from what you saw and what you got is vastly different. Now, truth is, our behavior is wired for specific expectations when we trade. And the expectation is, I see 1900 price and I want to get 1900 price. But the truth is, we see 1900 and we get 1901. And if expectations and outcome mismatch, our brain looks for intent. But the truth is, market doesn't have intent, it just has order flow. Now, the order flow is easy to understand, but is usually not what the brokers and traders community tells you it is. It's usually way different. Now, with understanding how the price execution will work is not really difficult, but one thing that will kind of discard it all and help you when you trade is just to understand that you need to have a leeway. Rather than entering at a specific price, enter at a specific zone. So meaning there will be some leeway for you when you're entering. And although you do get slippage every now and then, sometimes it can be positive. So maybe you entered even in a better price of that zone. So rather than looking for specific amount, let's say 1900, you might be looking for 1910. Anything between 1900 and 1910 is fine. And factor that into your risk management. If you look at it this way, it will be a little bit easier on your brain and obviously maybe even on your pocket, because you will not trade yourself out of profit. No revenge trading. Have you heard about the grand illusion of control? At some point, every retail trader overtrades. You see, trading in its own sense feels like influence. When you're clicking and you're executing, you're making a decision, it feels like you have control. And up to a point, you do. And that's because action reduces anxiety. But clicking to execute orders does not give you an edge. Because edge comes from positioning relative to liquidity, risk and volatility. Regardless of which market you're trading on, it will be probabilistic system. That's why I'm always preaching the victory loss preparations, because you need to prepare for every eventuality. So if you count on probabilities, you understand when to execute, that's when you get an edge. So again, markets are probabilistic systems, not reaction machines. How we can trade off of reality. All right, let's have a look at the difference between market execution and instant execution. As a retail trader, you will be looking for price certainty. Every retail trader does. It's pretty normal. But institutions, they want execution efficiency. So those are two different priorities. And as a retail trader, you will be trading with institutions. So we need to look at it a little further. Now, if you have instant execution, then you're somehow protecting your expectation, because you get executed instantly, meaning you probably get closer to the price you see. Probably, not always. Now, the market execution, that one reflects the reality. And guess what? Reality is dynamic. So as a mature trader, you would need to be adapting to reality and not demanding stability, where stability pretty much doesn't exist. So if you are a maturing trader, then you have learned to adapt to dynamics, not demanding stability. My goal in trading is improvement over time. And if you think about it, what is the real enemy in trading? Most traders that I work with telling me always the same thing.
Peter, I know what I'm doing. I know the analysis, but every time when I'm trading, I just cannot control myself. I know what I'm supposed to do, and I try to do it. When I'm on the market, I always do the opposite.
And then they come back and say exactly what was wrong. But then when they go back to trading, they just repeat the same mistakes. And the same was happening to me, and it's pretty much happening to everybody who doesn't master control over their emotions. Now, this is easier said than done. Anybody can sit in the video and tell you
need to master your emotions.
But the truth is, you need to start practicing for the specific things that you will be facing, and understand that it will not be easy to control it, because it never is. Because if it would be, probably everybody would be doing it. Now, the real enemy, therefore, is realizing what we don't want to accept about ourselves. And that's why we're always going to be looking at, in this channel, into trading psychology. But what we're really doing is we're looking at the mind of a trader. And sometimes it might not be a pretty picture. So knowing about how execution works and understanding it deeply, it will uncover those uncomfortable truths. Number one is market doesn't manipulate us. It exposes our need of a certainty and our intolerance to randomness, and also our emotional attachment to our own predictions. When you understand the structure though, you know you need to stop blaming. It's not about blaming broker, the markets, the execution, and all of the stuff that we tend to blame when we want to cast some blame on something. And only when we stop blaming, we can start improving. I know it doesn't sound nice, but that's what it is. If we prepare properly and we follow what we have prepared exactly, no deviations, then the end result will be always better if we just reacting. And it always will be that. But we also need to understand the inner workings of a system in order to understand how we can predict the reaction of a system. And only if we decide to take one path and stick to it, meaning path of preparation and execution, that is the way to success. So let me summarize it for you. The final takeaways: if it feels like broker is against you, you are not crazy. You're just reacting to mechanisms that you don't fully understand. And slippage isn't manipulation, it's latency plus liquidity. So if you experience over-execution of your stop losses, it's not personal, you're just situated in a liquidity clustering. And realize overtrading isn't strategy, it's anxiety. Instant execution isn't safer, it might not be even better. It's just more emotionally comfortable. And the market isn't attacking you, it's just revealing you. And the action steps for you, what to do from now on? Expect slippage and plan for it. Mentally budget small slippage into your risk model. Stop placing stop losses where everybody places them, because they will get executed. Instead of asking yourself, where is a support, ask yourself, where would be retail stop losses likely clustered? And now you need to factor in going either above that or below that, depending on the direction of the chart, obviously. So think in terms of where liquidity likely will be sitting, not just where your analysis tell you where is support and resistance. And this can be factored in also with simple calculation of what can you handle and what is your position sizing. And reduce click impulses. Stop thinking yourself that you are sniping. And before executing trades, ask yourself, am I executing a plan or am I reacting to a candle? And if you feel urgency, which most of us do, just pause for 30 seconds. And don't look at the chart at those 30 seconds. Yeah, just take a break. Just 30 seconds is good enough to restart your normal brain function. And most emotional trades pretty much die in 30 seconds anyways. Now, an execution type should be chosen intentionally. There is not one is good and the other is bad. It's not about that. Only thing you should remember is not to expect perfect fills in volatile markets. They simply don't exist in a real one. And lastly, shift from prediction to probability. Instead of, oh, I was right, start thinking, was that justified? It's a good question. And if it is, you have risk control, you have correct position sizing, and you have liquidity awareness. Now, the final upgrade for you, the core upgrade in your mind as a trader, it's understanding that the markets are systems, not personalities. And that's when you finally can stop taking things personally. Now, here is where you can gain a control, and instead of reacting emotionally where you know you shouldn't have, you start reacting professionally. Now think about this. You are on the other side, and most traders are simply paranoid because the market doesn't punish traders. It exposes their misunderstanding of a structure. Once we fix the structure, paranoia disappears. Victory loves preparation.